at the beginning of the year. But you've been doing some
Yeah.
homework. You've been doing some homework, Benny.
No, I'm just looking at how things are opening right now. Looks like green, SPOs are up 60 bips. Ethereum's up 4%.
Who's up 4%?
Ethereum. Bitcoin's up 2%. Ethereum's up 4%. All right, so it's like modestly green here. I mean, decently green, I guess. All right. What do you think about this Trump 50-year mortgage, buddy?
Well, it's almost as controversial as the federally backed debt for OpenAI. It's a close run foot race. I'm not sure what was more unpopular on financial media. You know what? Make bond maths great again.
Yeah, I mean, adding duration years to the supply doesn't seem to be the thing that's going to get you rates down. So, you got to wonder, is it like the banks that are in his ear? Like, hey, I mean, because think about it. Obviously, there's a lot of tweets going around and stuff. The same rate, you don't save much. But the reality is you're not going to have the same rate. Very difficult to hedge,
Well, there's no market. Whoever writes that paper can't hedge themselves.
And it's not only that, it's impossible to hedge, but then it's also like, who's going to hold it? I mean, Fannie Mae's trying to go private, right?
Public.
And what?
Public. Well, they're trying to be privatized, right?
Yes, publicly traded, but privately owned, not owned by the government, basically, is what I meant.
Okay.
Yeah.
Privatized. Let's go with the old British word, privatize. They're trying to privatize it.
And the Fed is still shedding off their MBS and putting it into bills. So it's like, I don't know, like where they think this incremental demand is going to be for this excess duration when, it seems like most of the administrations for the last however many years now have been favoring the front end for supply rather than the back end. So yeah, I don't know. I don't know who was in his ear.
I think, are the home builders in his ear, right? Ultimately, is it the construction industry? Is it the home builders? Is it Pulte? They're trying to get the housing market going again. That's another stated objective. I'm not sure that this does it.
No, this is not going to do it.
I think this is going to be as much of a nothing burger as the sort of the $2,000 stimmy check that got floated over the weekend.
Yeah, I mean, I guess
that's why Bitcoin and Ethereum are bid at the open. That's why we've got futures green. Everyone's going, the liquidity's coming. Don't worry about it.
That is the assumption for sure, right? I mean,
I haven't got my screens up. What's the dollar doing at the open?
Down.
Much?
Not a ton. I mean, the euro's at 115.50 and yen's at 153.80. So it's DXY is in 99.60. I mean, rates are up a little bit, so not much. I don't know.
Okay. So first up and most importantly, what Sunday night football game are we competing with tonight?
I'm not sure.
Doing the split screen.
My Packers play tomorrow, so versus the Eagles. So I've checked out from football for the day. I kind of been working all day. I didn't pay attention.
Well, listen, let's start there because you've been doing a ton of work over the weekend that we've been talking about, and I think it's some really good stuff. When you go through some of that work that you've been doing.
All right. Well, we can start with what we were just saying and then go into it. But all right, let's see. The share screen. Here we go. Okay. Can you see that? All right.
I can now.
All right. So this is yours. I mean, he put a lot of crazy.
Yeah, okay, we can run through those. Yeah, let's do those first. I mean, we talked about this on the recorded show on Thursday. It doesn't look like that revenue line is going to be very long standing. I was listening to another analysis of how the arguments are going in the Supreme Court while I was walking the dog this morning. I think even the right-leaning justices are wanting to kick this into touch. Now the question is, what's the next play from there? And you raise the prospect that he brings back this sort of Tobin tax on foreigners, Section 899. I can't discount that either. I don't think it's a great idea, but I can't discount it as a possibility. But either way,
yeah, I mean, running a big trade deficit and having a huge thing. What did we say last week when we were doing this? 35 trillion of foreign ownership of bonds and stocks.
yeah,
That definitely could put the triple Yazoo in play, at least initially, right? And it doesn't even require selling of assets, right? You could have a new demand for hedging, right? That has kind of abated. If you think about it, dollar weekend till end of June, early July, and then it kind of went sideways. They got the one big, beautiful bill passed. And then recently it's been climbing higher, kind of hit, what do we get? Just a little north of 100 on the DXY.
Yep.
And kind of stopped in its tracks when when the Bank of England didn't cut, and then you started to see some of these test balloons kind of fly out a little bit. But I mean, yeah, you can tell by the frequency of these crazy tweets that their mind is, they're chasing right now.
Yeah.
And so I think that's the risk. I think the 899 is probably the actual risk. I think also the idea of tariffs, yeah, it's a tax, but I would argue my buddy George Robertson, I remember in April, had posited the idea that, hey, the market figured out that this would be overturned back then. And we've had pretty much up only with, a few, issues like the Iran attack and this recent dip. And then, like a couple things, but nothing serious. And so does he start proposing some crazy new stuff? I don't know. And uncertainty definitely doesn't decrease if they revoke it, right? So yeah, you get this rally, but then you have increased uncertainty, which, what's the old adage? Markets hate uncertainty.
Well, and CEOs hate uncertainty. And what do with uncertainty is they lay people off and they stop spending money apart from buybacks, right? So, that's at that point, you've got to wonder when it starts to feed into flows. Sorry about my voice, getting really croaky for our first live.
Yeah. So, I mean, we'll see. I think that would probably be my concern. Like this combination as a bond bull, this definitely, both of these things make me a little bit uneasy. The idea of the 50-year mortgage is ridiculous. And then, now he's talking about, he floated the idea of giving a tariff dividend, but it's like, hey man, you might have to refund the tariffs. It doesn't inspire confidence, I guess.
So when do we see the steepener back? Because I think this is I think 899 is a real steepener risk. I mean, people might still look at the bill market, but they're not going to be very close to the bond market. That's for certain.
Yeah, you could see the short end stay anchored. And I mean, term premium for the 10 years, like 61, 62 bips. You could see that make a jump higher if there starts to be this uncertainty. I mean, to date, the whole year, bonds have traded well, but I think it's like tariffs, and there's been, tariff.
Well, the whole year except for Q1.
Fiscal
right.
Rolling change in fiscal spending has gone to zero, basically. So, after that initial bump from the imports bonanza, if you will, prior to tariffs, and then which spewed a lot of dollars out, and then the weak dollar kind of helped markets, and we had like a little echo boom from that. That's clearly worn off. And, you just look around at the consumer reports, and I know we're going to talk about restaurants a little bit later, but restaurants have been terrible. Harley Davidson, which I know we talked about, 6 months ago or something, it's down only. Six
Well,
Flags is down
actually,
only. Dave and Buster's
well,
down only, right?
and so actually, funnily enough, some of those large tickets, discretionary purchases, like Harley Davidson, like Brunswick, actually had a bit of a rally over the summer, and it was beginning. I mean, I'm short both of those, and it was beginning to get up comfortable, and they've just completely rolled over with the restaurants in the last few weeks. The restaurants are very weak midsummer, then had a bit of a rally with everything. This is just last week in factors. I was interested to see that the financials held on a little bit last week in a softer tape, and you were talking about those. I know that the large banks have been bugging your book for a few weeks.
Oh, I'm such an idiot. I mean, I can't believe I spent like the last 3+ months short Wells Fargo and JP Morgan when you could have shorted anything like regional banks, Jeffries, the BDCs, the PE shops. They've been terrible. Like any of that stuff. And instead here, I'm sitting short JP Morgan and Wells. But, my buddy Charlie Peabody's covered banks forever. I'm Portales Partners, who's a partner of mine at Wall Street Beats. He's just like, look, the market won't roll until the big banks roll. And I kind of think that's right. Like, they held up. Apple held up as well, which we'll talk about in a little bit. But that was the thing that was kind of the give, that there was stuff that was holding in pretty well.
Yeah, I mean, I got stopped out of an Apple short several weeks ago. I mean, I went after the buy now pay later guys, and that was one of my most short-lived short trades for a while. But I'm still got my eye on them, and I really think that the only reason that sort of Apple is defying gravity here is that it's just not spending like the rest of the hyperscalers.
I think that's right, and we can show that. If you look, here's the hyperscalers, and this was 10/28 was that day that I tweeted out, and a lot of people noted was the worst breath day in the last 30, 40 years or whatever, when market was up and only like 18 or 19% of stocks were up. But with the top heavy nature of the market due to the passive, and I mean, also just the ass kicking by these top companies. But you saw pretty sharp moves down, 4% of aggregate market cap, so like $1 trillion lost. But Alphabet and Amazon had good prints and they traded well, even though they did have a drawdown. But if you notice the max drawdown during this 10/28 to 11, Apple was solid as a rock, right? Alphabet was fine at 2.2. But then, I've been short Meta. I covered the Meta and the NVIDIA on Friday. Just, I don't know. It was just kind of one of those things where you could see this. I think that this canceling of the flights is going to put pressure on a reopening. And you're seeing, you started to see a headline Friday. And then now over the weekend, you're starting to see it. I mean, I think that, we're just talking about policy. People are like, whatever. But then if you're talking about people can't get home for Thanksgiving, or it's screwing up business travel or whatever, the pressure will ramp up in a nonlinear fashion, I would imagine. But yeah, I mean, the one thing that you see, and we'll just talk about it now, is you saw Oracle over the last month or so's CDS has doubled, which is a big move. Seeing CoreWeave's just since 10/28 jump 100. Basically it's continued to go up to the right. And if you look, I mean, valuations are absurd. We can come back to that, but like this is you look at Oracle, right, and 27 billion of trailing.
When you walk everyone, I'm familiar with the table, but why don't you walk everyone through the columns here just quickly?
Yeah, it's just it's the capitalization and revenue, EBITDA, cash from operation, capex, free cash flow minus share-based compensation, because you got to remember those are actual payments. And then free cash flow minus share repurchases minus dividends. So you think of that as like discretionary free cash flow, right? And this is what the credit market will care about. And that's why you're seeing the two ones that are very red are where you're seeing the most. You're seeing the most credits like spread widening. And then here you see how trailing 12 months Meta's still fine, but next year going to be in the red. And this is with revised up cash from operations, which I haven't gone through enough, but I'm just taking, this is Morgan Stanley's numbers, close to the consensus, or maybe it's consensus. I can't remember which one it was, but this is basically the street's numbers, not my numbers. And this was closer to like -17. So, take that for what it is. But these guys got their equity re-rated, although they were able to place 30 billion of debt, a week or so ago. And that,
just so that I'm clear, on the total debt columns you've got there, are you including the SPV debt or not?
No.
Okay.
No, I didn't, because they have the recourse, but it's not exactly debt, right? Like the debt is on, for example,
they've written a put on those data center assets.
That's a better way to think about it.
That's a liability in my book, to be honest.
They don't, for sure. There's no question. But I didn't go through the math or the thinking. I didn't spend the time to think about, how are we going to price that, basically? But yes, they own the left tail of that operation. So it's roughly like, if they cancel early, then what's the value of it? They own like under some strike price, so it is like a put. They have the rest of the liability, the recourse, if you will. But yeah, they have two $30 billion data center deals with PIMCO, Blue Owl, and I can't remember who the other player was, but so significant amount of VIE, which is, just so everyone knows, that's what like Enron used, the off balance sheet. Then they did an actual $30 billion of bonds. So if you want some 50-year bonds, we just got 2 new 50-year bonds. You got Google put out some 50-year bonds, and so did Meta. But yeah, IG's been a little weak. IG being investment grade, credit spreads.
Well, everyone's got to make space for those deals, right?
Yeah, exactly. You got to make space for those deals. And one of the things, as a guy who owns credit default swaps, been short credit for a bit, one of the things that's been going on has there just not been enough supply. And there's a lot of people who just like that extra yield. And there's mandated funds that have to buy. So the demand for paper from investors has exceeded the demand for paper issuance by borrowers. So this is starting to change that. For high yield, it's more of like they're going to refi the COVID paper. So that's coming. But yeah, again, just kind of lays it out where you can see that this free cash flow number, net of like commitments, is fine, but it's starting to be weak up and the guys who got hit the hardest, with the exception of Nvidia, but Nvidia really just gave back that blow off move. It was at 180, and then I shorted it around there, and then I was like, what the hell just happened? It went up 14-15%, and then it came back. But if you look at, and again, these are Street's numbers. Nvidia's cash from operations and free cash flow, Street has them doubling next year. All this CapEx just funneling into these guys, right? So 393 trailing 12 months, 550 next 12 months, 40% growth. Now, this is where you would think, like, are they going to grow the top line 16, 17% and EBITDA? Like Google, for example, Street doesn't have a ton of revenue growth, but then they have this massive expansion in EBITDA and cash from operations. And then obviously, as a result, free cash flow doesn't change that much because they're ramping all that increment they're putting into CapEx. So, in general, I just think it's like competition's increasing, capital intensity is increasing, market's starting to show some signs of caring. Now, they're caring not for everyone. They're caring for the guys who actually, I don't know what's going on with Oracle. Oracle seems to be the weak link for sure. Besides CoreWeave, which is a whole different animal.
Yeah.
They're not part of they're just one of the guys who are spending a lot of CapEx, right? They're going to do.
And then we'll get to it in a second. Then you've got that Fermi IPO that we can look at in a second, which is like a theoretical version of CoreWeave that might exist at some point in 2 or 3 years.
Lambda also. Yeah, I don't want to get too much, but all that stuff basically, got dropped pretty hard, and much more than this. So the Oklos of the world, the Fermis of the world, the Iron was down decently on its print, and that'd been a total home run in ripping.
This is all the reconstituted Bitcoin miners that have pivoted to compute, right?
Yeah, those and what's interesting is,
just on that, yes, they've got the power deals, they've got the data center, but they've got to pivot all the tech, right? Bitcoin miner is an ASICs-based compute platform, and so they've got to rip out these data centers and stick in Blackwells, right, to play in this game.
Yeah, but they have access. What Bitcoin miners are really good at, because it's a hyper competitive business, is that finding cheap power sources. So on my last podcast with Nadine, the Just Think About It podcast, we had a guy named Ruslan on who had been running a Bitcoin mining operation. And then we were talking to him like last September or something. And to be fair, I should have listened to him and bought those stocks. And he was doing the same thing. He was moving into this, and he was just like, look, colo, like you can do, latency is not as important for training as it is for actual operation, because then you have to be closer and closer to Virginia or one of the hubs, because you can't. So, but what they're doing is they're going to be in the Permian, the Bakken areas. Natural gas in West Texas is damn near negative, right? It's just a waste product. Yeah. And so, if you can have access to that, and you don't need the same demand as being live, so a lot of it's for training. 10 megawatts, 15 megawatts versus these gigabyte plants or any of this stuff that people are talking about. Fermi's kind of trying to do that. But anyway, the point is that there was a blow off in everything, September, and some of it all the way to October 28th. And it feels like it was a give back. And so now the question is like, was that the blow off top, or did you just kind of take that away because government's been shut down? Finally, we had some liquidity implications of that, and stuff that's got high beta to liquidity, namely crypto and all the stuff we just mentioned, finally comes in, because they're mostly trading off the leverage machine versus the, actual cash flows, right?
Listen, do I think that the dip buyers are dead here? Absolutely not. I think they will keep going till they've only got one limb left. In my view, if you look at the sort of the chart of the Nasdaq futures, the Nasdaq 100 futures, every time it's poked its nose below the 50-day, right, it's just sort of sprung straight back.
But yeah, I guess this is a thing. Like, if you're a bull on these names, and you look at EV to EBITDA last 12 months, next 12 months, 27 times trailing, it's rich, but it's not insane. And 20 times forward is, for these quality businesses, the bull will argue that's decent, right? And I think Chipotle trades around there, for instance. and then basically you move down the line and you get over to the free cash flow yields, especially absent or cutting out the stock-based comp, and it's pretty thin. And like I said before, the discretionary is even thinner. So the question really is are they going to have to lean on the debt markets to grow? How much more runway do they have of free cash flow? And the market just told you they're not super interested in debt financed CapEx if you don't have the excess cash flow, or you're starting to have balance sheet issues. And again,
did the market say that? There was a wobble last week. I think that
definitely, because I think that you look at who was like, look, Oracle popped on some bullshit on that OpenAI announcement in September, went up 40% from 240 to 340. And on Friday it was 335 at one point, right? So it gave, or 235. It gave back the entire move, and its credit spreads have gone up 40 basis points along the way. And 40 basis points in high yield is whatever, but 40 basis points in IG going from 40 to 85 is a big move, very big move. right? That's about equivalent of a 1/3 hit to your equity, which is exactly what you saw. You saw a 30% plus decline in the equity. And I think Meta, which didn't have, still doesn't have any CDS, it will soon now that it has all those bonds. They re-rated the equity down versus the the credit per se. But if you look, I mean, their free cash flow, 45 billion trailing, expected to go to 27. So you're seeing that go the wrong way, and you have to be more and more confident in that the return on capital, that CapEx. And I think there's a decently justified argument that there's some uncertainty, right?
So, I mean, this goes back to a conversation that we've had a number of times over the last few months. At some point, the Zuckerberg. I mean, I've always maintained that large language models do as much as he needs for ad targeting right now. At some point, I mean, it doesn't feel like it at this stage. He's still pretty chest pumping when it comes to wanting the leading foundation model, but at some stage he's going to be dealing with a rating rebellion.
Well, that's what happened with the metaverse, right?
Yeah,
changed his name. He was all in the metaverse, and I ended up buying that stock at $92. When you look at it, and it was like, well, it's trading like 8 times. They'll cut costs. So, like,
you know what he should do? This is something we've talked about before. He should just go, you know what? We'll just we're coming out of the foundation model game. It does what it does for us. We're just going to buy Snapchat because we need to own Gen Z now. All right, just get back to his knitting.
Well, especially if OpenAI is going to shift towards ads. The Amazon, Google, Meta have like 50% of the ad market. I mean, let's just say that slowly climbs up a little bit. But if all of a sudden OpenAI is a player, someone's going to have to give that share up, right?
Yeah, it's interesting because all of these businesses,
and TikTok, right? TikTok still continues to grow.
They all carved out slightly sort of corners of the market for themselves. And the trouble with the new AI invest is that they're now starting to creep into each other's territories. So there's moat leakage everywhere. And, I mean, the power of the story starts to get sort of pretty aggressively diluted when they're all sort of trespassing into each other's territories. It's gonna kill margins everywhere. But I think just back to sort of market animal spirits, and we're on the half hour now, but let's have a look at that sort of the autumn offensive in terms of IPOs. It's something that we're gonna focus on a lot on these calls. But I mean, I'd grade the autumn offensive as a B-, and this is basically all of the deals of a benchmark size, so over $200 million. I'm not really interested in the sort of $40-50 million IPOs done by sort of tier 3 book runners. But it is interesting if you look at the cumulative P&L. I mean, just it's positive, but the deals where retail got a look, sort of names like sort of Gemini, StarHub, have been major P&L negatives. And then you get this genomics business, $1 billion to 1 last week, and that was a classic management heavily involved in allocations, which means that nobody got anything. So if you were sitting on a buy-side ECM desk so far this autumn offensive, you'd be going, yeah, this isn't great, right?
I mean, you're the guy who ran the ECM for big banks. You tell me.
I just think they're not bringing their best and brightest right now. They're really not. And actually, you've got another thing with the government shutdown. I just wonder how much more paper we're going to see between now and Christmas, because I don't imagine the SEC is approving filings right now.
Yeah, I would guess not. I mean, right? Like, the SEC is not doing anything, so I can't imagine that there's going to be just a huge normal end of the year push the way that you historically do, and that's obviously terrible for ECM, DCM bankers, right? They want to get that paper out.
Yeah.
It's an interest, but I guess they just did these bond deals, so somehow those got out, right? I mean,
I think
maybe those were in the works already.
Those bond deals are kind of, anyone that's got a benchmark kind of has to own those, right? Are they going to go into the indices? I don't actually know that for a fact, but these are big deals that you're going to be looking over your shoulder if you don't own them, right? And why wouldn't you want? I mean, why wouldn't you want to take sort of meta risk at a premium spread, right?
Yeah, I mean, I think that's
if you're in that
right.
business. I mean, I couldn't be excited about owning them for myself. But yeah, overall, kind of a B minus, and not really. You've been a big fan of the sort of flying cars thing. We had a little flying cars IPO last week in beta technology. It's sort of
people seem to like it, but it's down already, right?
Yeah, I mean it's I mean it's down slightly. I mean it priced at 34. It closed on Friday at 32. I mean it actually never beat where it opened at 34.
Yeah.
You're just anecdotally.
I like Joby.
Quite a few of my readers have been playing, through the SoFis and the Robin Hoods to get these small allocations in these deals, and it's quite instructive to learn the ones where they're getting stock and ones where they're not getting stock. Now, I was remember when, and this is about sort of back 10 years ago, Soros did an experiment whereby they we're going to ask the banks, all our relationship banks, saying we're going to take 1% of every deal, right? Irrespective. And Soros was probably about the only firm that could probably get away with making that ask. But even then, even they were unable to get 1% of the truly hot deals. So you had, a negative selection bias, right? And they eventually gave up on that program after about sort of 12, 15 months, because, even with their, their calling card with respect to the sort of syndicate desks of the street, they couldn't get that full exposure to the deals that really worked.
Yeah. And so, look, the Circle, that was one I shorted this summer after its initial move, shorted like 240. Although I had to eat a day, the final day when it went up $60 and went to 300, little butt clench moment. But that's back at $100. Yeah, it's just look, you've been around the IPO game a long time. Like, it seems like more and more of it is, come out really high, get a pop, and then it's just tough to see the follow on. Whereas back in the day, it was like true growth capital, and there was good times to get involved. It's just less and less.
In so many of these cases, you're just looking at multiple secondaries off into the distant future, right? So many of these deals are being structured with a very small amount of primary capital for growth for the business. I mean, I'm just looking at these things again. I mean, interesting, there are a few deals that have done pretty well. I mean, but I noticed the one from the week before last. This was sort of AI-driven travel agent type business, Naven, right? It's just been a complete lemon. And I think I'm certainly hearing the narrative about some of these businesses that are sort of being grown on top of the AI LLMs, right?
Of course. I mean, you need a narrative, right? If you're not trading on cash flow, you need a narrative, a growth narrative.
My largest single stock short is Salesforce, right now, and their latest narrative is that they're growing their agent force business on top of these models. I'm just not seeing it.
It's interesting. I saw that Joby, we talked about that beta, whatever you want to call it. Just kind of, I think they cozied up a little bit with the administration. There's a couple new deals they'd signed, and I don't know. Like I think those guys are the best. I had the CTO on my podcast, and stock was $5, and they were doing an offering, and that's where Toyota got involved. And I was like, all right, I like this, and just seems it's done quite well since then. And they're all speculative, but I think I don't know. If you're going to own something,
okay. So listen, I mean, it's a classic case of great deal, business question mark, right?
I think the business can be. I think it can do well. To be honest, I think it can.
So we're going to have a rerun of our Waymo fight, aren't we?
No, I'm just telling you that I mean, this guy was the CTO at Tesla initially, and he just said how it's a cluster of very smart people tackling an interesting problem. Trying to replace helicopters and trying to replace regional planes, and regional planes are garbage, and so that can be a big thing. And if AI ever happens and you get rid of the pilot shortage cost thing, and you have $100 billion plus company. I don't know. That's when you buy right tail. That's how you have to think, Rupert. You don't say, oh, what I'm paying 12 times EBITDA.
For a boy from Wisconsin, you're really speaking Californian right now.
I mean, I think most people would know that I'm fairly skeptical of most speculative stuff and tend to be leaning towards bearish side in general. But you need a few right tail options in your portfolio. I'm sorry, you just do.
Sure.
And let's go to the last thing, and then we'll call it for the night. Rupert's been on the restaurant short. I was on it a little bit earlier, but I tweeted out, Dave & Buster's back at the Liberation low, Harley Davidson just at the lows, Six Flags at the lows. These restaurants, you've been short the Cava, right?
Yeah, I've been short these 10, right? These 10 and the things. So that's Wingstop, Starbucks, Texas Roadhouse, Darden's, Chipotle, the Cheesecake Factory, Brinker's, Shake Shack, Cracker Barrel, and Cava. And just going through the transcripts from last week, I mean, they're only just beginning to come clean with just how damaged their consuming cohort is right now. And I think we can see this basket, back at the October 23 lows, at which point, I'll start to keep an eye on short interest and keep an eye on RSIs. But I still think there's legs in this trade.
It's a popular short, though. It's interesting because let's see, like,
not that popular because these names are pretty small, right? There are a lot of people short the big QSR names, the big fast food names, but these names, there are a couple of, there are a couple of names where, like Cracker Barrel, where the short interest is getting quite high now. But
I guess like Chipotle, 16 times forward EBITDA, doesn't have debt. It's still high margin business. Where do you buy that, for example? 10 times, 12 times? Like where it would account for maybe you'll have another miss or two, another quarter or two of misses.
I don't know. I mean, these are all stocks that are firmly in downtrends right now. We've had some sort of 1-2 day rallies from time to time, and we had one in Wingstop last week. It got sold pretty aggressively. Ultimately, so much of the valuation, was not on forward cash flow multiples. What they're doing is that the market's been attempting to sort of discount back a total addressable market and a store rollout program nationally and internationally, which people are then trying to sort of discount back to today. But you've got to have a serious sort of growth stonk hat on to be valuing businesses on that kind of narrative right now. I think we're in a market where people will start getting focused on the quarterly EPS revisions, and those are now all trending down. I think
I mean,
Podworld is going to stay short these names.
I mean, Chipotle is at the 22 lows almost, right? It's in 22 here. I'll just show you real quick, and then we'll call it here. Just share screen. here real quick. Here we go. So there we go. I mean, it's roughly around the levels it was at in 22 on a price basis. It's off. Nickels got out of there right at the top, basically. Is that right?
Yeah.
Sometime last summer. And then I shorted it around here in last December and then covered in the spring. But like that shows you, though, some of these things staying short, you just have to deal with the inevitable. It's not gonna go in a straight line. You're gonna have to take a 10 to 20% counter trend rally.
I've got one thing. I was on the Starbucks, obviously, where he went to. One of my readers just sent me a very scary message this morning. Thank you, Lord Prime 2. He said he pointed out that his wife had been all over these new Barista cups from Starbucks. I think I'm about to be Hello Kitty'd on my Starbucks jaw. Keeping an eye on that now. These are cups for designed to hold cold beverages that are already being sold and resold on eBay for as much as $500.
Really?
Yeah, we've got a Beanie Baby thing going on.
Yeah, like the boo-boo,
buddy,
whatever that is.
Labubus. Yeah, I've still got a tiny position in my Labubus. That's Pop Mart in Hong Kong, 9992. But I started selling that when they got onto South Park. Anyway, Benny, before my voice completely goes, let's wrap this up here.
Yeah, I think so. Let's just finish it off here. And then, basically, it'll be interesting to see. I mean, the market, it's up 40 bips, came in just a little bit. Gold's kind of there. I mean, it'll be interesting. The last thing, let's say gold, what do you think about gold here? It's kind of consolidating around 4,000.
So I collared my gold in mid-October. And I just collared it. I had put on a zero cost collar around what is a pretty big position for me. I'm kind of like 6% gold in my beta portfolio, but I collared it out to January. I think it corrects in time here.
Yeah.
No particularly strong views beyond that. I think you need to own an overweight position relative to most.
Yeah. I'm not agreed. I mean, look, I've owned the gold bar since 2003, but we did short gold at like 43.70 or something via some puts, and that worked out well because I don't think I ever remember a 10% down move in a week in gold. I feel like that was one of the sharpest. Because I don't think it really was supposed to go to 4,400.
It was kind of begging for it, right? Because they just jammed everyone
thinking it would stop at 4,000. Then everybody who had the limits and the shorts at 4,000, they jammed them. They had to cover higher, went to a stupid level. Then basically the normal thing that happens. I was talking to my partner. What do you think ends this? I was like, same thing as always. They're going to raise the margins, and then that Friday, the next day, silver margins up 8.5%, gold margins up 6.5%, and then that was it. It's always kind of how it goes.
I think it's fine. I think it's healthy. I think it's healthy.
I mean, it wasn't healthy going up the pace it was. That's for sure. You want to see it. Gold's low vol. You don't want to see it become volatility exploded on that. So you'd rather see that thing in steady eddy, not going up. $100 a day, like that starts to get a little bit heady. Anyway, I think we call it. Anything else?
Nothing more from me. We'll see everyone on Thursday evening. Thanks, everyone.
And also come find us on YouTube, Benny_Squirrel. We're gonna run this whole thing out of there.
We're staying on that one. Benny_Squirrel, are we?
Benny_Squirrel.
Okay, we'll send it all. If you guys are following us, you'll find out the ways to get this show. I'm still wondering whether the Substack version is just a video of my ceiling, but let's see. Okay. Cheers. Thanks, everyone. Bye.